Finally, there is some life in the market. After several days of a very flat market with no real traffic, we finally have some action. In fact, we even made a small profit. Not a lot, but a small profit. And that's what it's all about. Little profits here and there. So let's get into the chart. Hello, I'm Robert and welcome back. Right now we are looking at the monthly time frame and we can see that this market really hasn't done very much at all compared to last month. But let's get to the daily and see what's been going on. So here we are at the daily with all of the trades currently in place. Now remember that the purple line is the median between the highest high and the lowest low of the entire market. So we are doing pretty good in terms of what we expected the market to be within the upper and lower ranges. How long will this trend continue? Who knows? But it has been very good for the process. Personally, I think it will go further downward in order to bring us back down to the average of the market. As we can see from going back even further in the market, the pinkish line at the very bottom is the market average. This is where the market price averages when you look at the entire history of the market. And we can see that the gap between the median and the average is quite significant. When you have a gap this significant between your median and your average, your market is going to predominantly be more along the short side. That is, even though the market is going to make highs here and there, the overall price value is going to always go back down into this intermediate range between the median and the average as a common fluctuation point. That's actually good because it gives you stability and predictability within the market, so that as you're trading, you have a good idea of where to look. As we look at the market, in fact, you can even see that most of my current trades are within that range. I have a few outliers waiting to trigger, and I may in fact at some point even adjust or add to that. But for now, let's get back to today's market, where we can see overall the basic upper range and lower range is still pretty much being considered stable. The order book itself is rather flat as well with this particular pair. There's not a lot of traffic in it, which is good because it gives us a way of measuring volatility within the market. In double checking the order book, the volume is so low right now that it's not even really showing on the chart. So there's nothing wrong with that. It just goes to show you just how slow and conserved or reserved this market is. It makes a good market for the lazy trading system because you can simply sit and wait. And that's good. You don't have a lot of traffic. But a lot of what affects this market is really its leverage. This particular market only has a leverage of 10 to 1. That means for every $10 of margin you use, your actual real world is only going to be $100 of purchasing power. Or for every $1 of margin you use, your purchase power is going to be $10. That's going to affect the end result of your profits, which we can see that the profits, comparatively speaking, are very different. Leverage is a wonderful way of controlling risk and augmenting your profits on pairs that have good leverage. For example, Euro USD has a leverage of 50 to 1. That means for every $1 of buying power, your actual risk is only 2 cents. Wonderful in a way of being able to make a good, clean, consistent profit, but absolutely dangerous if you over leverage, because it's very easy to over leverage and ruin your account. But as we look at the profits for a few of the other pairs I've been trading, you can see by looking at the number of units. Let's see if I can get this right. Let's move this over. There we go. So by looking at the number of units, for example, right here, 627 units. That is quite a bit compared to the 157 or 159 units used on this particular side. Let's get back to where I was. So we can see how the units themselves differentiate on the basis of the leverage within a particular asset. This particular asset has significantly higher leverage, and this is a 20 pip profit. So by looking at leverage, leverage is buying power. So for 2 cents of risk, we can buy $1 worth of the asset on a 50 to 1 leverage. But for a 10 to 1 leverage, it is $1 of risk for $10. So it is really, or 20 cents for $10, depending upon, which way you want to calculate the 50 to 1 versus the 10 to 1. The difference is important because that controls risk. So if you are looking at your risk, that shows up very clearly in the table when you're looking at your liquidation point. That is an important factor of consideration because every purchase affects these two numbers. The more you purchase, the more real money you consume in your account affects the availability of your future purchases. So if you have an asset with a 10 to 1 leverage, it takes more real capital at risk to make a profit. And this is where people really get themselves in a pickle because they over leverage their account trying to make any real money. Now for the case of what we demonstrated here, let's get rid of this. For the profit I made here, 59 cents, this is roughly 59 pips. So, $59 pips at 59 cents. So we have that. So let's turn this off, go down to, where is it? NZD Canadian. This is a 20 pip profit for 53 cents. So we have a 10 to 1 and a 50 to 1. And you see the drastic difference between how leverage works. So it took me more money with the pound euro to make 59 cents than it did with the New Zealand Canadian dollar to make 53 cents. The pound euro took 59 pips, whereas the New Zealand Canadian dollars only took 20 pips. That's a significant difference in the likelihood of profitability. It also means that if we extrapolated this out, just going to 40 pips would have doubled this to $1.06 for profit for New Zealand Canadian. So we can actually see just how different the leverage factors are within the account and why so many people want high leverage accounts. High leverage is good as long as you understand that it's not just the profits that are affected, but also the losses. And you can wipe out and over leverage your account very quickly. So you need to be careful with leverage and really practice it out in a demo account. That is why you see my particular position sizes are so well controlled. I work them out based upon the leverage, figuring out how to get these numbers. It is absolutely important to focus on risk management in this case. Higher leverage is astronomical risk. Lower leverage is less risk. I'm never going to say no risk because that doesn't exist in the market. The best you could hope for is less risk. But the higher you go with your leverage, like 100 to 1 or 500 to 1, is a staggering level of leverage that will destroy your account if you go too high in your position size. With a 500 to 1 leverage, if you take your account to a high standpoint of leverage, like what many YouTube videos demonstrate, you will literally blow your account in one single trade. You must take care to practice carefully in a demo account to understand the significance of leverage in relation to your trading. Okay, so let's clean this up and get things back to normal. So as we continue looking at the pound dollar, Australian dollar, the biggest question is, where do we go? Where do we think it's going to go? Personally, I think it is going to go back down to the most recent low. Now, we may already be at that range to where it might start going back up again. That's possible, and we need to wait and see. But I still think that the bottom part down near the 204 range is going to be the likely candidate based upon what we're seeing in the market. But either way, I've got a position up here waiting to trigger should it decide to kick in. I may put another position in this range here just to kind of capture some intermediate profitability. Good. 59 cents is 59 cents, and yeah, I can wait for those kind of profits all day long. But that's the nice thing about this kind of system. I'm not pressured to force to get into the market unless I want to. I can wait to see what the market is going to do. And if the market decides to trend upward, I may just very well place a position where I've got the indications on the chart just because it seems like it might continue holding that range a little longer. Again, think range, not absolute. This is a big gray area, not a fixed hard lock wall. So by focusing on that text, that contextual representation, you can get an informed idea of where the market is going to be. Don't try to predict it, but simply flow with it seeing where your opportunities might lie. And by using position sizes that are appropriate to your account, you can capitalize in a situation that helps make sure you always stay ahead of the game no matter what the market does. Share your thoughts and let me know what you think. Hit that like button and subscribe for more content like this. Leave me a comment. Do you like this market? Is it too slow for you? How do you think this kind of a market will play out in the long run with its low leverage? Let me know. Thank you for watching.